So we were just talking about bank statement loans and some of the changes that have happened here recently. For us is that usually when you have a loan that doesn't really meet the normal criteria, it's outside the box, it's more risky, we'll sometimes send those directly to an investor to underwrite. So it's a channel we have. It's not the same thing as like a broker would do, but it is similar. But recently they have delegated us for underwriting for those products. So the 12-month and the 24-month bank statement program that I was just discussing, along with 1 year self-employment. So that helps some of these folks that maybe they've always been in the same business, but they just recently finally got around to being incorporated or setting up their LLC or whatever. Because first things we do when someone says they're self-employed is we'll go to the Secretary of State website and we'll pull and see how long they've been, incorporated or when did they start it. And some people will go do that part of it, but then they won't actually start doing it on the tax returns right away. So there's a lot of detail involved in confirming whether or not somebody is officially self-employed. But that being said, that gives us a little bit more control. We still have to follow their rules and do it the way they want us to do it. They're going to still double check us along the way, make sure we calculate the income correctly. And just again, because I know we've talked about this before, but bank statement programs, and I'm doing one right now for a purchase down in Florida. We're going to take, for example, a 12-month bank statement program. We'll take business or personal bank statements. And so in this case, I'm taking business bank statements. I'm looking at all his deposits for each month. So it's a little bit of a tedious process. So just a heads up, it's not the kind of loan you rush, like you just can't flow right into it. You kind of got to get your ducks in a row, gather all your documentation, and then there's a lot of analysis that goes into putting these together. Because we have to go into each bank statement and itemize out which one is a deposit. And like, for example, with my guy, he transferred money from another account into that account. Well, that doesn't count as a deposit. It's got to look like it's a business-based piece of income coming in. And so we go through that process on each month, put it into a spreadsheet. It calculates the income. It's a gross income. And then you usually will take what they call a debt factor, which is like the investor will assume that, well, he's got expenses, right? So he doesn't make all this money. He's got some expenses. And so the easy one is 50%. If we can qualify him by hitting him for 50% of his gross deposits, that's just the cleanest and easiest way to do it. You can qualify somebody with less expenses, but that requires like getting something from his CPA saying that his average expense ratio is like 10% or 20%, which might be the case. In my case, his is lower, but he qualifies with the 50, so I'm just gonna keep it simple. And then we take that and average it for the 12 months, and that's the income we use. And oftentimes that will work, pretty easily because you're talking about someone's gross deposits, and they usually are bringing a lot of money in. It's just when it comes to tax time, they like to write everything off. So, but more importantly, what I want to talk about today is the fact that we do have the 1 year self-employed. So that'll work kind of the same. They'll look at assets. So the only problem you might have with that one is if the business is really fresh and they're still building and they don't have much money coming in. But what I've seen here recently is someone who's already been in the business. They just technically started being self-employed, meaning now they get 1099 or something. And so they're already making the money and they're putting the money in the bank. And so they could show 12-month bank statements to document that income. So that's really kind of and it's another thing that we're delegated to underwrite. So, so that's really kind of it in a nutshell. It is a little bit simpler loan. Rates, depending on credit score, you do have to have a decent credit score. Down payment, usually when you do these programs, they usually want a little bit more down. You're not going to find a 3% down or usually a 5% down. It's usually going to be more like 10% down and decent credit. But they'll go down to as low as I think 660 with some of the programs, so that's not horrible. But that's pretty much. It's just another weapon to use to try to find a fit a need if someone can't go full doc and go traditional. And the rates are usually about a point, if they have good credit, about a point higher than what the normal rate would be, which, it is what it is if you're self-employed and you otherwise are not loanable. And these loans don't have prepayment penalties, so we can always, we filed a couple more tax returns, and as they get further in their business, yes, they're writing stuff off, but they're also making more money. So just a regular full doc where we average 2 years will look better, and they could just refinance out of this and go to a normal, rate. So does that all kind of make sense, or pretty straightforward? Any questions? You've not been here a lot. I recognize that. So just this second opinion thing is working with us internally. We try to pre-underwrite all the files that we're working on for all the realtors here, and so that allows you, if we've pre-underwritten the file with like a TBD address, no real address, but just kind of pad like the worst case purchase price and all that, we literally underwrite the file. So then you can go in and make an offer that's not contingent on finance, which we have already had a lot of success with people getting their offers accepted because it had no finance. In some cases, we do no appraisal because we'll do the appraisal inside the due diligence. So so that's the benefit. But if someone says that they've got a lender, just to give us a chance to talk to them, just to vet it and make sure that there's no like red flags that we want to make you aware of, even if they don't use this. We try to work with the person, but if they'll at least let us look at it, we give them a gift card just for giving us a shot to look at it. So it's really kind of no harm, especially if they just had their credit pulled by the other lender. I mean, that first 30, 45 days, it's not going to affect them. It's just the first person who pulls it that affects their scores. So then they have that window of time to shop. So does that all make sense? All right. Well, that's kind of what I have for you, unless you guys have some specific questions or anything you're dealing with, any tough situations you're dealing with currently. We're always available. Again, we're here pretty much every day. Someone's here on different days, and then we're here for the Wednesday meeting. But numbers are on the door if you ever need us. But just give us a call. That's all I got for you today. Pretty straightforward.